Hi, welcome to an introductory video on cash and receivables. So in this module, we're going to talk about the accounting issues that arise around the cash and receivables accounts. So cash, this includes items readily available to pay off debt or to use in operations. So of course it includes currency and coins, balances in checking accounts, and items acceptable for deposit in these accounts, checks, money orders received from customers. Then there's also cash equivalents. Cash equivalents are very short-term and liquid financial investments. Examples of these include money market funds, treasury bills, and commercial paper. Commercial paper are very short-term borrowings between entities that are under a contractual arrangement to help each other when one entity has a little excess cash at the end of a particular day and one entity has a little cash deficit at the end of a day, and then the CFOs write a contract and make a little loan to each other. Very short term. In general, cash equivalents must have a maturity date no longer than 3 months from the date of the purchase of the financial security. Now, an issue that will arise always is hugely important is internal control over the cash. Needless to say, cash is very attractive to steal. You will study this in very great detail in auditing class, but let's introduce it here because it is so important. Internal controls safeguard the company's asset and improve the accuracy and reliability of accounting information. So that's in general what internal controls are. Internal controls over cash receipts include separation of duties. Separation of duties refers to that persons who handle cash should not have access to the accounting records. They should not be involved, the person handling the cash should not be involved in making journal entries. They should not be involved in reconciling cash balances in the accounting books to the bank balances. To accomplish separation of duties, one person opens the mail and logs the checks received. Another person deposits the checks, and yet another person makes the journal entry. And another person reconciles the accounts. So if that's true, then it would take a lot of collusion to steal money from the company. Another internal control over cash receipts is that we reconcile the cash account with the bank account regularly, usually monthly. Internal controls over cash disbursements. In general, all disbursements should be by check. This provides a permanent record of the disbursement. All expenditures are authorized before the check is prepared. We compare the invoice with a purchase order and a receiving document. We verify proper general ledger balance to debit. The expense account, the accounts payable, other. The checks should be signed only by authorized individuals. And then once again, we need separation of duties. One person cannot approve a check to him or herself. And again, we reconcile the cash account with the bank account regularly. Right, and that is the internal controls, the usual internal controls over cash disbursements. And then that's one thing you will do as an auditor is you will take a random sample of transactions and ensure that the company is adhering to all these important internal controls and limiting the possibility of a theft. Excuse me. Now, another concept Another aspect of the total cash on the balance sheet is restricted cash and compensating balances. Restricted cash is cash available for only cash available for current operations or to satisfy current liabilities is classified as a current asset. Cash that is restricted in some way and not available for current use is reported as a non-current asset in either investments or other assets. Examples include compensating balances and sinking funds. You'll learn what these are over time. Compensating balances typically arise where we have a banking arrangement. One thing the bank requires is that we leave a certain amount of cash in that bank. Sinking funds are a similar contractual arrangement. Yet another current asset are current receivables. Receivables represent a company's claim to the future collection of cash, other assets, or services. Receivables resulting from the sale of goods are known as accounts receivable or trade receivables. Non-trade receivables include tax refund claims, interest receivable, and advances to employees, among others. When a receivable is accompanied by a formal promissory note, it is called a note receivable. So let's talk first about the accounts receivable. These are created when sellers recognize revenue associated with a credit sale. Revenue is recognized when a seller satisfies a performance obligation that does not require the payment of cash. If they don't pay cash at that time, if the seller has performed their performance obligation and completed the performance obligation, they have earned the revenue, and so they will accrue the revenue, and if the cash isn't required to be paid yet, they will set up an accounts receivable. The accounts receivable is that corresponding right to receive payment. They're informal credit arrangements supported by an invoice, and they're normally due 30 to 60 days after sale. And accounts receivable is the most common of the current receivable types. Okay, and that's a quick introduction to the cash and the cash equivalents line on the balance sheet. In the next few videos, we will look at other issues that arise around the cash and cash equivalents and the receivables balances. Thank you for your attention. Have a great day.